Hey guys, I'm so happy to have you here, and it's just so great to have you here. It's been a while since I've put a lot of new information together, so I'm pretty excited about this conversation that I want to have with you. And that's how I see it, is a conversation. So when things come up, if there's something that you don't understand or that is not clear to you, just go ahead and type in the question, and I will get to it during Q&A, and then we can go from there. So this talk, it has many names. The magic filter, the three magic filters, how to position your portfolio in a contraction cycle, what to do with your money now that Trump is president-elect. They're not different topics. They're different ways of looking at the same information. And for many reasons, the same reason that Obama got elected is the exact same reason why Trump got elected. And I'll talk about that a little bit in this conversation with you. So, first, guys, I am a registered investment advisor and a certified financial planner, and I need to read this disclaimer to you. The opinions expressed in this training is for general information purposes only and not intended to provide specific advice or recommendations for any individual on any security. It is only intended to provide education about the financial industry, determine which investments may be appropriate for you. Consult your financial advisor prior to investing. Any past performance discussed during this program is not guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested in directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek direct advice from a licensed professional. Okay, guys, so this is me. I've been in the business, and I'll talk about what specific business that is. This is my 19th year. This was right when my daughter was being born. I took a break, but I did a lot of work on TV. This is just Bloomberg here. And I took a break after my second kid was born just so I could have time. And I'm thinking of maybe getting back into it again. But I've been teaching people what I call what really works. This is my 19th year. And I'll talk about who buys my services and what kind of how they've gotten here. But I've been in the trenches. I have the point of view like you do. I did not grow up in the industry. I grew up questioning the industry, being skeptical of the industry, even before it was in vogue. And so I've always fought for clarity first, and that's something that people often don't fight for. So that's me. Agenda, it's going to be very straightforward. Number one, I want to make sure to identify who, gets the most value out of being in my world or having me being invited into your world, because that's really important. That's the foundation on many levels. Then I want to do the training. Then I want to offer kind of a different way. And then I want to take your questions and answer them live. So the first thing I want to talk about is you, because it's important to understand where you might be. So first of all, people who come into my world, they've tried the big box advisor, whether you call it the big box, the independent, the boutique, it's the same. It's the conventional idea that you diversify your money over 10 different asset classes, 20 different mutual funds, and then you reshuffle them or rebalance them once a year. And that is the model of the big box. And look, the data is very clear that you will get the market returns minus fees, commissions, expenses, and a performance gap. So if the market goes up or down 20%, you're going to get that 20% minus the fees, the commissions, the expenses, and the performance gap. And over the last 19 years, what I've noticed is that's somewhere between 2 to 4% lagging a year, adding up all those. So basically, you're going to just get the market minus, let's just call it an average of 3% smaller each year. And so what usually happens is people kind of notice, well, look, I can have my money go up and down with the market. I don't need to pay you. And most people don't really realize they're paying that 2 to 4%. They just see that the kind of the top line money management fee. But people have tried the big box approach and realized that it didn't work. They then went into what I call the pick of the month newsletter industry. And this is a $1 billion industry. It is huge. It's billions of dollars. And the pick of the month newsletter industry is where you sign up for a pick of the month newsletter service that has maybe a specific idea of deep value or gold or energy or something like that. And you get 1 to 5 amazingly written stories a month on why you should absolutely buy fill in the blank. The stories are very well written. They're written by people who really understand how to craft words. And our human brains love these stories. And so what we end up doing is buying stories because we have this Pavlovian type of response. The problem is we interact too much. There's too much buying and selling. There's too much missing structure. And in fact, this do-it-yourself step does even worse than the big box approach. But people come to it honestly and go, but what is it? What is it that I need to do? And so they go through this process, whether it takes them 5 years or 10 years or 15 years, and they still don't know what really works. And they've gotten skeptical. Maybe they've gotten very skeptical, but not cynical yet, or just not cynical. And that's when somehow they come into my world and they say, look, I got the big box approach doesn't work. And I get the pick of the month, $1 billion industry, newsletter industry doesn't work either. What really works? And one of the reasons why people like me in their world is because a big part of my approach is it has to be straightforward, cannot be complicated, and a working professional who's married with a spouse and kids and friends and a life and wants to work out and do things has to be able to implement this thing. So it can't be about spending time in front of the computer each day. Now, let me just say this. Okay, let me just say this. It's okay if you want to spend time in front of the computer. Most people think they have to, but they don't really need to. I'm just looking over. Hold on. I just want to make sure everything is running good, because I had a couple of people say I have no background music going on, guys, so I don't know if any of you, only one person hears it, so it's probably not all. So that's kind of who works with me. But what they're really saying is, I want a better way. And so back in the 90s, I built a better way. Now look at the screen here. This is, and we're going to get to the training, but look at this. The blue bars is a strategy that I have called market probability. And I wanted to show you in a way that makes sense. So down here at the bottom, it's a 7-year rolling performance. So from 2000, 2006, from 2006 to 2012, and all these across, it shows the 7-year performance. The blue line is my strategy market probability. The red line is the S&P 500 with dividends reinvested. Okay, so let me tell you exactly what this means. Go here to like 2005 to 2011. Right between there, we had the worst financial crash since 1929. During that 7-year rolling period, okay, the S&P grew your money with dividends reinvested a total of 20%, right? That means you started with 100,000, you end up with 120,000. The blue line, the blue bar, is market probability. During the exact same time period, the exact same market, the exact same economy, that 100,000 grew to $247,000, right? So a significant amount more. In fact, it grew $127,000 more. So just to show you what these bars are actually representing, you notice this is the worst 7-year performance that the market probability strategy did between 2005 and 2008, which, by the way, is pretty darn impressive considering there was a 58% fall right in the middle of that. And that was the worst 7-year block since people have been buying my research and implementing my system. The best S&P was from 2009 to 2015, which happened after a 58% fall in the market. And even still, market probability still outran the S&P 500 with dividends reinvested. So really, when we boil down to why are people really saying, RC, just show me what to do? It's because they want their life kind of in the blue or on the blue line. That is really what's going on. And I'm going to show you how straightforward it can be. So those are the type of people and kind of what they've gone through to get here and say, RC, I'm not cynical yet. I'm super skeptical. What really works? Okay, so training. Let's talk about the training and what I want to help you understand. So the first thing I really want you to get is whether you should even be in or out of the market, right? That's the first thing you should really know. And then the second thing is what's the best location, what's the best size, and what's the best type of stock. So location would be, if you live in the US, it would be domestic, right? US domestic versus international. The best size would be like jumbo, large, mid cap, small cap. And the best type would be those 10 sectors that make up the S&P 500. Energy sector, financial, discretionary, staples, utilities, telecom, healthcare, materials, for example. And then 3, I want to show you why this whole training works, because the why it works is important to the human brain. So let's first start with the kind of in or out. Okay, that's the first thing I want to start with. So I do not believe that buy and hold is the best investment strategy. Now look, it's actually a pretty darn good strategy, because if you think about this, the US stock market is up 78% of the time in a stable uptrend, 78% of the time. So out of 100 years, 78 of those years, it's doing really well. The problem is those other 22 years. There are catastrophic losses in those other 22 years. And the problem with buy and hold, which is probably the second best strategy, is it never really hits the gas pedal during those stable uptrends. And as you know, 78% of the time we're in a stable uptrend. So what I did, I said, look, let's take this foundation. Almost no one can beat the S&P 500 over any 7-year time period. Almost no one can. What if we just took that as our foundation and just added 2 things to it and just simply said, look, catastrophic losses, how do we avoid those? Let's add that ingredient in. And during stable uptrends, let's just kind of go for it a little bit. So that's what I did. That was the foundation where I wanted to really find out, how do we really, make the market work for us? And so what I got was a strategy. Now look at the screen here, because this is really important. Notice that there's periods of time where the strategy itself is flat. Now back in 2000, both the red line is the S&P 500 with dividends reinvested. The blue line is this market probability strategy. And we're going to get to the 3 filters, the 3 magic filters. But I want you to understand, first, you got to know whether you should even be in the market or not. Then you see these flat lines, a step up, a flat line, a step up, a flat line. You see a flat line here for about 18 months. You see a flat line here. Those are the periods where this strategy said, hey, you know what? Step aside. Step aside. I don't know what's coming, but the probability of having your money be safe and growing has dropped. And so one of the reasons why the blue line is so much higher than the S&P is because this blue line, literally all this blue line is doing is stepping aside from catastrophic losses. I'm not even pressing the gas pedal yet. I'm simply saying in or out, yes or no. There's no gas pedal being pushed during that 78% of time with a stable uptrend. So even if you didn't do that, just knowing when to be in and out of the market is going to change the growth of your future. It's going to change the security. It's going to change your choices. And it's because of knowing when to get out of the market, because during that time period, quote unquote, with your money doing nothing, the market was falling pretty serious. Okay. Again, this is how the blue bars can put you on a significantly different trajectory than just buying the S&P 500 with dividends reinvested. That's buy and hold. Now look, I want to tell you right now, there is no pick of the month newsletter, okay, that can beat the red lines, even the red bars. I know that sounds like blasphemy to anyone who runs a pick of the month newsletter, but if they were being very honest and looked at their returns with a model portfolio, and they don't do this, no one does this. They take average returns, they show you the big winners, all right? But they don't put it into an actual portfolio where here's our 20 stocks, put 4% or 5% in each stock. They don't do it in a real world way. And if they did, they would underperform even the red bars. The reason the blue bars, which is market probability, have given people a much different outlook with their future is because we avoid those catastrophic losses. Pretty impressive. Okay. So the first thing I really want you guys to get is, before you even use what I call the 3 magic filters, which is what's the best location, what's the best size, and what's the best type, the first thing you have to understand is, should I even be in the market? And I want you to understand something for anyone, and most people get this who are interested or who have come into my world, but most people know that we're all timers, not old timers, but we're all timing the market and we're all momentum investors. And let me just quickly say what I mean by that, or actually clarify. So sometimes people are like, oh, I can't do this. This is timing. So first of all, this is not day trading or week trading or month trading. And if you just go back to this screen here, you can see that most of the time we're just going with the market. Okay. But what I want you to understand is everybody's a timer. Those buy and hold people who hold for 20 years, they're timing because the stock market doesn't care when you get out or get in. It doesn't. And maybe when you need to take your money out is not a good time to take your money out, right? That's a timer. So there's different types of timers. There's ones that are based on structure and systems and checklists, right? And then there's the, well, I'm scared, I want to get out, or my knee is hurting this week, or I don't like the news that I'm reading on my Facebook, link or tweet, or, and I'm out, and then I'm in. Yeah, those timers are dangerous. There are periods where I don't think you should be in the market, and there is very strong evidence and science and facts and history behind why I'm stepping aside. And the last thing before we go on to location, size, and type is we're all momentum investors. If you were to step back and look at 120 years of the stock market, you'd see it go from lower left to upper right. So we're all momentum investors. Okay, so let's talk about location, size, and type. And this is looking at the 3 magic filters. Like, how do we make this even better? How do we hit the gas pedal when we're in one of those stable uptrends? Okay. Of location, right? Of size and of type. We're going to start with location, and we're going to spend time on location to prove a point. So most of us have been introduced to this idea that you should have your money in international stocks and you should have your money in domestic. And I'm saying US domestic. So, about 70% of people who invite me into their world and buy my service research, they are living and based in the US or paid in US dollars and have large exposure to the US stock market. And the other 30% live overseas. But just look, from 1970 to 2014, right? A long, long period of time. This is a long period of time, 45 years. On average, the international stock market went up 10.5% a year. And on average, the US domestic stock market went up 10.4% a year during this time period. So what most big box advisors would say, or conventional advisors, or even pick of the month newsletter people, like, you can't really figure it out. They say, look, it's about the same. So you should just kind of diversify into both. And when I look at people's portfolios, and I do an audit, I do this portfolio audit for people, I'll see anywhere between 20 and 30% of their money exposed, sometimes more, sometimes less, exposed to international. And that's a huge drag. But what they say is, no, RC, you never know. You never know which one you should be in. And so when you look at these numbers here and you talk to big box or conventional advisors, what they say is you got to diversify because sometimes one of these is up over the other. And you can't know which one it is. And you can't try to figure out which one will perform better because that's a fool's errand. You don't want to be a fool. So you just kind of diversify into both of them. But I want to debunk that right now. And I also want to debunk kind of this whole pick of the month newsletter because you don't need to be getting different picks each month. You do not want to be doing that. So I want to show you what this looks like. So the question is, should we be in international or should we be in US domestic? Right? That's the question you want to be asking yourself. Ask better questions and get better answers. And so I took some data. Now, if you just look at this data right here, you're like, it's average, sometimes one up, sometimes the other is up. But if you plot that information on what's called a relative strength price chart, you start to see something very different. All right, so look at this going back to 2002. So we're looking at a lot of data here, not just a week or a month or a quarter, but we're looking at a lot of data. When this line is going up, and just so you know, this line is comparing the international stock market against the US stock market. So if the international stock market is growing faster, has more strength, more relative strength than the US stock market, okay, this line is going to go up. And if you notice, the line was going up for 6 years, from the end of 2001 to the beginning of 2008. So during those 6 years, 1, 2, 3, 4, 5, 6, a little bit more than 6, you actually wanted to be more exposed or all exposed internationally. But that something happened in 2008 and that baton got handed from one runner to the other runner. And since that 2008 baton handoff, US domestic has been greatly outperforming international. Now, this is not a trivial amount of money, right? And I'm going to talk about in a minute how it actually shows up in someone's life. I actually have to get over to my notes. I take lots of notes when I do research. But guys, if you know the best location to be in the world, then it can help you protect and grow your money. Because if you want to write something down, write this down. The safest place to put your money is in the stable, uptrending asset. That is the safest place to have your money. Not in bonds if you're 60 years old or stocks if you're 30, but the investment that's in the stable uptrend. That's where your money is safest. And so when you see this line falling, what that is telling you is the US domestic stock market is greatly outrunning the international stock market. So if you live in Europe or Australia or Hong Kong or South Africa, that means you want to have a lot more exposure to the US stock market than your own domestic market or even to other international markets around you. It's the US stock market. But I want to show you, look at this. I want to show you this, how you can look at this in a different way. This is the same data. Now, this goes from 2010 until recently. And this shows you, like, look, they both were going up. Domestic, that's US domestic, that's the S&P 500. And international, Vanguard Total World Index minus US, is also going up. But just for example, say you had a $100,000 portfolio back in 2010. And you had, let's just say, a 25% exposure to international because someone told you that it should be that way. Whether it's in your 401k or your brokerage or at Merrill Lynch or pick of the month newsletters that say you got to have exposure to international stocks. The problem is if you had a $100,000 portfolio and you put 25%, or in this case, $25,000 into international, over those 6 years, that $25,000 is going to grow slower than if it was all in US domestic. And the difference between those two is pretty significant. At a minimum, it's a 50 percentage point difference. That means that $25,000 grew only $12,500 and not another $25,000. That's a difference of $12,500 or 12.5%. Guys, that's a lot. That's over 2 percentage points per year for something that you didn't. That's a drag on your life. That's a penalty against you, right? It's like you're sailing and you've got this hole in the hull of your boat and you don't even know it. And you're trying to build bigger sails and learn techniques of sailing better while you have this leak that's slowing you down. So knowing the best location is going to help you safely accelerate. And guys, this is not doing dangerous things. You can be 85 years old, and the safest place you can put your money is in a stable uptrend. Whether it's all US domestic or it's all international, the safest place is to have your money in a stable uptrend. I really want you to get that because that's a difference that makes a difference in people's lives. And the difference between these two lines isn't the 50 or 60 percentage points, though that's clear. It's that the person who knows where to put their money, knows the best location, means their money is growing faster, it's accelerating, and it's doing it at a safer, in a safer way. It's actually moving faster. It's growing faster, but it's being more protected. This idea that more risk, is riskier. People don't even know what risk means anymore, guys. Here's the takeaway. Know the best location on the planet and put your money there. This is the same data, but I'm showing you this in a relative strength price chart. So this is comparing domestic, US domestic against international. Notice this line. Your brain can look at it and go, yes, this line is clearly falling and has been falling since 2009. If it falls, again, it's the same data as this. I'm just showing it to you in a relative strength price chart. When it's falling, that means international is underperforming domestic, and you don't want to have any exposure to it. This is the way of making up for lost time. This is the way of getting back control over your future. This is where the power sits. And it's not about day trading or week trading or month trading or quarter trading. It's about identifying that stable uptrend and then positioning your money there and stepping away. Okay, so that's location. Now there's 3 magic filters. One is to filter the best location in the world. One is to filter the best size, and one is to filter the best type. So the best size is jumbo cap. Those are like the super big ones like Apple and Microsoft. Like we're talking huge, 400, 500, $600 billion companies. You have large cap, you have mid cap, and you have small cap. Well, just like I showed you with international and domestic, the same thing is going on with all the different sized companies. So now, doesn't something kind of strike you interesting? That when you really break down the entire market, there's really only, in some ways, 3 types of investments. Ones that are trending up, ones that are trending down, and ones that are just confusing looking. They don't have a trend. It's really interesting. Like you could even say how many types of investments are there on the planet. You say, well, there's really only 3. But if we then drilled in, you could say, well, within that, how many are there? And then we could say, well, there's really only 3 types. There's the location of stocks, there's the size of stocks, and there's the type of stocks. So we can do the same thing looking at relative price charts, saying, look, is jumbo outperforming large? Is mid cap outperforming large? Is small cap outperforming large? Is small cap outperforming jumbo cap? And so on. We can look at these and say, which sized company is the best one to be in? And as of today, the 2 that are doing really well, literally recently, is mid cap and small cap. But here's the key. You really want to make sure you have the right time frame. So that second filter is knowing the best sized stock. And then the third is knowing the best type. And when I talk about this best type, literally the energy sector, material sector, technology, financials, staples, discretionary, telecom, healthcare, utilities, and industrials, right? You have these 10 major asset classes. Maybe you should not be in technology. Maybe you should not have bought that pick of the month energy newsletter, because if energy has been underperforming and you're learning about stock picks within an underperforming sector, that's not going to help you most. And I guarantee you there are newsletters that just sell financial ticker symbols, financial pick of the month picks for financial companies. Well, guess what? Financials, that sector, has greatly been underperforming the S&P 500 since 2009. And I mean greatly. So stepping back and using these magic filters, right? Knowing the best location, knowing the best size, knowing the best type, and then stepping in, which you don't even have to, by the way, at that point. You can just buy the best one. You can know, hey, look, small cap are doing best right now. I'm just going to buy a small cap ETF. Hey, you know what are really doing well? In addition to small cap, maybe I'm going to go ahead and just get discretionary, right? So it's easy to build a portfolio that you do not have to trade in and out of, that will outperform all pick of the month newsletters and big box advisors. For example, discretionary and small cap. This is the difference that makes a difference in people's lives. So I really want you to understand how we're kind of building the structure of the system. You have to know you have to know whether you should even be in or out of the market. That is foundational. If you remember back to the 2008 correction, global financial crisis is what people have named it, or back to the dot-com collapse, dot-com crash, technology crash of 2000. All those pick of the month newsletters, they never stop selling you their new story each month. Guys, if the market is collapsing, I don't care about the new Facebook of China or the Google of South Africa or whatever the story is. And look, I read those stories because my clients send them to me. I'm fascinated. I want to buy them. I start salivating like, I got to get this. That's not how you grow your wealth, though. The second is using the 3 magic filters. What's the best location on the planet? Domestic, international, developed countries, emerging countries? What's the best sized company? Yeah? Jumbo, large, mid, small? And what's the best type? Looking at those sectors. This is how you safely accelerate your money. And then 3, I want to talk about why this works, because if you understand why it works, then you're more likely to use it. This is ultimately about getting control back of your future. First of all, it works because you got to know whether you should be in or out both of the market and of which is the best sized stock, which is the best location in the world, and which is the best type. That's the first thing. That's one of the key reasons why it works. The second is when you use those filters, what I call the 3 magic filters. And again, the 3 magic filters are what's the best location, what's the best size, and what's the best type. But what happens is it filters out the noise, the news, the complexity, the pick of the month industry. Again, because if the pick of the month industry is selling you financial ticker symbols, and that's not the best type, and maybe you shouldn't even be in the stock market, you got to filter that out. And most importantly, your own behavior. And it's actually our own behavior that is the biggest downfall, because ultimately, all of your decisions, all of your choices, they sit in the bowl called what I believe to be true, how I behave. They sit in that bowl. And so if that bowl is one of day trading and I don't know, and I'm going to jump over to this, I'm going to jump over to that, I'm going to try a little bit of this, and okay, it didn't work out this week, that's the behavior that has someone lose their money slowly over time. So the reason why it works is these filters I'm talking about. It filters out the noise, the news, the complexity, the pick of the month industry, and your own behavior. Secondly, and as importantly, you both know in absolute terms and in relative terms where the strength is. And this is key. It has to be growing in absolute terms, right? So that means the thing you're in actually has to be going up. And if nothing is going up, get out of the market. Get out of the market. And what you're in, you want it to have relative strength over everything else in the market. So you want to be able to identify the absolute strength and the relative strength. And those 3 magic filters do that with the help of that first step, which is, should we even be in the market? And then the third reason why this works is because of the time frame. I mean, think about the time frame I just showed you guys. I was showing you data over 5 years, 10 years. Now, within that, I'm looking at a lot of information. But notice that I didn't show you a price chart over the last 3 months, right? You are going to want to, parts of you are going to want to zoom out so you can really get the picture, really get the point of view, like, which direction am I going? Like, which direction is this going? And what I see when people are technical investors, they look at price charts, they've got the wrong time frame. They're way too zoomed in, and that gets them in, gets them out, gets them in, gets them out, gets them in, gets them out. And if they were to just to get the right time frame, to take a giant step back and go, oh, let's look at 5 years of data in the right way, and then be very clear on which direction the trend is going. When you have the right time frame, and when you know how to make sure that what you're going to invest in, that asset, right, is both going up in an absolute time frame, right? It's actually increasing, and a relative strength way, an absolute strength and a relative strength, then you're going to be positioning your money. And here's the thing, guys. This word complexity is very important. This is not complex. Now, you may be like, RC, not complex. Easy for you to say. You've been doing this. This is your 19th year teaching it. Once you get it, it's super straightforward and it's easy to get. It's easy for your brain to look at a price chart and go, I completely get that. The way that the industry tells you, even the pick of the month, especially the pick of the month, and this is why it's hard for the human brain to see this, because the pick of the month newsletter industry, they rail against the big box advisors and the conventional advisors. So you're coming to them thinking, okay, these guys have the answers. But they tell you the same thing in a different way. They tell you to diversify, right, over all these different asset classes: large cap, small cap, growth, international, mid cap, value, bonds. Oh, and by the way, you got to really make sure you shuffle the deck chairs every so often. Yes, I'm being sarcastic purposely. Because look, if your money is in steerage or is in first class or has a balcony view or is in the presidential suite. It doesn't matter if your entire portfolio hits an iceberg. You can shuffle those chairs. You can, Wall Street calls it rebalancing. You can do as much as you want, man, but if your overall portfolio hits an iceberg, you're done. The whole thing sinks with it. Now, I call this red line because if you remember to the price chart, that bar chart I showed you, the red one is just kind of the buy and hold S&P 500. But the pick of the month newsletter industry is as guilty, if not more. Because people go into the do-it-yourself world being like, okay, the big box, they really aren't there for me. But the pick of the month, I mean, they're amazing storytellers. But if you were to be very honest and have them really compare and put their picks in an actual model portfolio, which no one does, you would see that they underperform just a buy and hold S&P 500 with dividends reinvested. So instead of kind of this red line diversification, think of it as the blue line. If you remember those blue bars, you want to be able to have a choice, right? So if let's say this boat right here, let's call this financials. Well, it's still out there sailing, cruising, and as soon as it starts outperforming clearly in an absolute strength way and in a relative strength way, great, let's go put our money over there. But let's look at all the boats because eventually all of them are not at the same time, okay? And if they all do hit an iceberg at the same time, we have that first step, whether to even be on the ocean. And so real diversification, a real strategy, I shouldn't say real because the other ones aren't fake strategies, but to have a real effective strategy. And look, guys, we have a recession in front of us coming. That's not fear-mongering. We will have a recession. We know historically the market falls 35% on average for the average recession. If the recession is worse, it will fall 45, 55%. If it's shallower, the stock market will only fall maybe 25 or 35. I mean, I should put quotes around the word only. But when you have this approach where it's like, look, I don't need to be on any boat. I don't even need to be on the ocean. Then you start to safely accelerate your money. That's real. That's a real strategy that can protect you. And that's why when you look at this price chart here, the blue bars, even the worst one from 2005 to 2008, which was the worst stock market correction literally since 1929. That one was 89%. But this was the biggest one. It started in 2007, ended in 2009. That was a 58% fall. And still, the blue line, it still took that $100,000 and made it into $247,000 over that 7-year time period. And that is power. But again, we're not day trading. We're not doing pick of the month. We're being very straightforward here. And that's what you'll often hear me say. I fight for clarity. I fight for simplicity. And that's why people say, you know what, I need to have this. So look, there's a certain type of person who hires me. They want to know, should I even be in the market? Because they want research that says, look, there's some period you shouldn't. And then if I am in the market, where should I be? And then when should I move? When should I move out of the market? And when should I move to a different asset class? That's it. Those 3 questions. It's very straightforward. People say to me, RC, I love the straightforward approach. That's what I've been looking for. That's what I thought that's what I wanted when I went into the Pick of Yourself newsletter world. But what I realized was I love the stories they write. I mean, they're so well written. They must have PhDs in English or literature. But what people who hire me or hire us buy our research, they're saying, look, just let me know, should I even be in the market? And if I am, if we should be, where, and then when should I move? Because that's how you get on the blue line. That's how your money gets on the blue line, right? That's when sometimes you just take a break and you step aside. That's why the blue bars can be so much higher than the red bars. So I do have a monthly service. I call it Fearless Wealth. It was an idea that I came up with in the 90s because when I was teaching myself, and I'm self-taught, I was fortunate enough that when I graduated college, I graduated with an Asian Studies major and a minor in Mandarin, and I lived over in Southeast Asia and sold software. And I earned very well. I was paid very well. I guess that's more proper English. I was paid well. And so when I came back after the years living in Asia, I wanted to really crack the code. with investing because my parents had their life savings embezzled when I was a teenager by their financial advisor. And it was a financial advisor that they trusted and they liked. And so going into my 20s, I just remember thinking, I don't want what happened to my parents to happen to anyone else I can ever reach, and certainly not my parents again. So I built this company called Fearless Wealth because I just felt so much fear when I was in my teenage years after my parents had their life savings stolen from them. Now, their financial advisor stole everybody's money. He was very democratic about it. But all I wanted to know is just, I want to eliminate the fear. How do I get rid of the fear? How do I get rid of the fear? How do I manage the fear? Right? And so I started this service called Fearless Wealth. And the monthly service is knowing whether you should even be in the market or not. Really what specific location, size, and type to buy. How long to stay? How long should I stay in? These are the things that people really want to know, and they want to know when I should be out. And you've heard me say it again, this is not about being in and out each day or each week or each month or each quarter, even each year. It's riding that stable uptrend. That's what's most important. And I get that the $1 billion Pick of the Month newsletter industry has kind of inculcated us to believe that it's about the ticker symbol. I'm telling you, it's not about the ticker symbol. It's about that stable uptrend. And I know a lot of those services, if not all of them, run between $100 to $6,500 a year. And the more you pay, the more focused they get, right? And I know they have huge upsells. You come in at the $100 and you get upsold to the $2,000 and the $6,000 and the $12,000. And there's just huge amount of upsells. But they're looking at that one specific niche or that one specific idea. But they never really tell you, I've not met a service that tells you when to be completely out. And that's what I wanted when this was in the 1990s. I was in my 20s. I wanted to know, should I even be in? I just wanted to know. And at a certain point, they're always selling the next stock pick, literally through the story or through an upsell. And I did not want that. When I was looking. And so when you eliminate the noise and when you eliminate the complexity and when you say, RC, just what's the big picture? You get on the blue line. You get your life on the blue line. And I want to offer you the idea of getting on the blue line, access to the strategy that gets your life on the blue line, that gets your security, that gets your freedom so you can get control back for $997 a year. And I want to talk about what that means and what you get. Not that if I just said to you, look, I'm going to make sure you get your money in the blue line. There, in many ways, probably doesn't need anything more to say other than I'm going to do it in a very straightforward way. But I want to kind of have fun with you here. I want to show you something. If you buy today, when you buy today, I want to give you something that is pretty incredible, right? About $19,000 in additional services for free when you buy today. And I want that to be an offer that if you buy today, you get. So I want to quickly tell you what that is. First of all, I will never upsell you any of my research. All right, so if you just fell off your chair, just know I will never upsell you any of my research. The only thing people pay for more with me is my personal coaching or my money management. That's it. All my research, if you buy today, you will get all of it for as long as you're a paid up subscriber. I will not upsell you to any of it. And I've got a deep library of research I'm going to show you a second. But you will never be upsold to more research. If you buy today, you get my online coaching course. I show you the actual strategies, how they work. And this is important so your brain can get the behavior. You got to get the right mindset. You really have to understand the history of the markets. I give you the white paper. I give you the checklist. This is my online coaching course that is worth way more than $5,000. But when you sign up today, I will give that to you in addition to the service of getting on the blue line. I also have a deep value real estate course that is rock solid. No one got hurt in the real estate crash, which started in 2007, who followed this course. It is an amazing course. You get it, where to buy today, how to manage your properties, how long to hold them. It is a powerful course. You get that if you buy today. And then I have these two other strategies, not just two more, but these two strategies, LTEC Gold and LTEC Bond strategies, which alone are worth $2,000 a year. I will make sure you have access to those forever, as long as you are a paid up subscriber. I show you whether you should buy and hold gold, whether you should buy and hold bonds, for how long, why, when, where. I show you these are back-tested strategies that are super powerful, and I tell you when to get out. Because there are pick-of-the-month gold newsletters that just keep telling you what investment to buy, but there's long periods of time where you do not want to be in the gold industry, and the same thing for bonds. And so I give you access to those two strategies. And then I have a strategy called the obvious trend strategy. Again, you don't need to use any of this stuff, guys. It can just stay in the library. You don't need to go to it. You can say, RC, just get me on the blue line. I totally get it. I simply want to make it easy for you to go, you know what? You're giving me everything today? No upsells? Right? When should you buy an individual stock? What's the best way to buy individual stocks? How do I know when the risk is the lowest? This is the obvious trend strategy that I built 15 years ago. You can have it if you sign up today. So this is what I'm offering you. What you're actually getting is this market probability strategy, and that's when to be in and out of the market. The 3 magic filters. That includes monthly reviews. I tell you exactly when, where, why, all that stuff. I send you alerts between the monthly meetings so you know exactly where to position your money. And it's very straightforward alerts. That's that $997. Right? Which actually normally is $100 a month. I didn't even do a price reframe on you. I just said, look, this is a killer price. But then if you buy in the next 24 hours, you will get all of this stuff for free, which is just shy of $19,000. And you can do that if you go to Fearless Wealth Today, fearlesswealthtoday.com. You can just go there. If you just go there, you can choose to sign up and you get all these. This is $19,000 of free. I don't even want to call it a gift because it sounds very infomercial, but I'm giving you everything there. Now, when you do order, I just want you to know the order form will look something like this: contact information, address, credit card, type of service, right? You'll fill that in. And then once you're done with that, it goes to this page here. You'll see me very casually looking. This is my office. That's a Hirschfeld drawing, if you know who Hirschfeld is. And I simply say, hey, do you want to get on the phone? Do you want me to audit your portfolio? You want a second opinion? You want me to identify your biggest gap for you? Let's do that. Let's just do that. So just know that you'll have that as an opportunity. Then after that, if you do say yes to that, I have you fill out a questionnaire. So when we get on the phone, it's super focused. And we're really focused on what is going on with your money and your investing that is not working. And so I have you fill out a questionnaire for that. And again, if you go to fearlesswealthtoday.com, and I just sent it over to you in the chat window, you can do that. And then you can have that choice. And I'll keep that, that page up for the next 24 hours. So I want to answer some of your questions. I know some have come in during the actual training part. And again, the training part was, RC, how do I know when I should even be in or out of the market? That was one part of it, right? The second was, what are the 3 magic filters? What are they filtering? What's so magical about them? Oh, knowing the best location on the planet for investing, knowing the best sized stock for investing, and knowing the best type stock. That is actually pretty magical. So having that access shifts and changes people's futures. So what I want to do is take people's questions live, and I'll look over here and let me see what we have. This one comes from Sam. Hey, Sam, RC, what do you think of trend following? You know, the question is what frequency you use, Sam. The shorter the frequency, the more dangerous it is. And the longer, the better, because you can really eliminate a lot of noise, which I talked about why the 3 magic filters work so well. It's because of the perspective, kind of me looking at longer periods of time. That's what makes the most difference. So I mean, look, we're all trend followers. Everybody's a trend follower, Sam. So anyone who poo-poos you on it, you know, your friend who has their money at, I don't know, Merrill Lynch or Bank of America, I know it's the same company. They're trend followers. They're following that huge 120-year trend of the stock market. The problem is there's just long periods of time where the stock market greatly underperforms the bond market. So that is why. So let's see how we have here. This is from Roger. Hey, RC, how do you determine what is in a stable uptrend? And then how do you determine when the market is going to fall and therefore get out? So Great question, Roger. So the first, how do you determine what is in a stable uptrend? I use price charts. So that's the first part of it. I look at price charts. And in looking at those price charts, and let me do this. When I look at the price charts, my brain, my optic nerves, which are connected to my eyeballs, they can look at the price charts. So can you. And I've been doing this for half of my life, my entire adult life. So it's easy for me to very quickly see how I can define a trend line. And I do it through using trend lines. First of all, it's a price chart. Then I put on trend lines. Then I put on moving averages. So I use price charts, put on trend lines, and put on moving averages. And then what I do is the trend has to force me out of it. And when I do move out of it, I'm not moving out of it 100%. I would dollar cost average out of it. And then the second part of your question, Rogers, how do you determine when the market is going to fall and therefore get out? So I'm not determining if it's going to fall. What happens is the approach I use, market probability, what it's doing is it's saying, okay, look, we know we have 120 years of data. And we know over the last 120 years, we know that, first of all, very rarely are there corrections more than 20%. Most corrections, like 95% of corrections, are all less than 20%. And if they're less than 20%, it's noise. It's scary noise sometimes, but it's noise. It's really not until they start breaking more than that. And that 20% is arbitrary, meaning it could be 18%, it could be 22%. But the point is, and 20% isn't part of my strategy. I'm just giving you kind of a marker here. So what I do is I build moving averages and I back test the heck out of them and I try to break them and I look for the best combinations. I say, look, when things fell apart in 2000 and 2008 and 1974 and 1953 and 1937 and 1929, some of the numbers that people know, 1980, 1982, 1987, when the market fell apart during those periods, what happened? Were there similarities? Did they act the same way? Did they act differently? Was it completely random? And what I noticed was when markets fall more than 20%, they all act the same way. The same things happen. And that's how I built these strategies. Okay. This one's from Edward. Hey, Edward, where do you see us being now, in or out? What location, domestic, what size? So where do I see us being now? First of all, I see us being in the market. Absolutely. I call it green light mode. You absolutely, the market is in a stable uptrend. So that's the first part of your answer. So that's the in or out. It's definitely an in. Then the best location in the world is the U.S. stock market. Still, today, it's the best location. So if you live in Europe, then that would be international to you. But in answering your question, the best location on the planet today is the S&P 500. And it has been for the last 7 years. Then you ask what size. This is a great question because when I told you why it works, having the right perspective is what makes you understand. So the best size today, and if I set aside risk and things like that, the best size today is either mid cap or small cap. But it has just broken out on a larger basis. On a shorter term basis, it's been the best place size-wise this year. Now you might say, RC, give me one answer. Like you said, mid cap and small cap. It's kind of a coin toss. It really is. Like in actual data, small cap is beating mid cap and large cap and mega cap, or I guess I call it jumbo cap. So the best size is small cap. So that gives you a perspective. And the way you want to manage your money is not that the size changes every week or every month or every quarter. Like you want to get it so, hey, the best size, you're in kind of that size for a while. Yeah, good question. And these are things that I go over on a monthly call with my members, and I email them and tell them the best places to be. So yeah, a lot of people ask if you're a current member, this is you get everything you need to get. So there's nothing else you need to do. Next question is from Ed. Hey Ed, are your recommendations ETFs in various sectors, industries, or individual stocks? For market probability, it's ETFs. For the sectors And for the, I call them type. So for the type, location, and size, it's ETFs. And I do have a strategy called Obvious Trend. That is about individual stocks mostly. The thing you have to understand is most people should never be in an individual stock, right? If you go back to the performance of the blue line that I showed you, if you go back to that, you don't need to do anything else. Like, that's the game. The game's won. You won the game. But in answering your question, that's what it was. This question's from Linda. I didn't hear the answer you kept asking. Hold on. How should I be in the market? Does this rely on how old you are, how much money you have saved or might need? Yeah, Linda, thanks for the question. How should you be in the market is based on what the market is doing. So conventional wisdom, the stuff that we're supposed to rail against, the stuff you learned from big box advisors, they tell you your age matters. Okay? They tell you your age matters, but it doesn't. What matters most, actually, let me rephrase that. Of course your age matters, but it doesn't matter to the degree that the big box advisors or what you've read to believe is true. So, out of 100 units of what's most important, what the market is doing is probably like 90 units of importance. And maybe your age is 10 units of importance, right? So if you're 65, that's important that you're not 35. But if the market's in a stable uptrend and it's outrunning bonds and real estate and whatever, your age, it for sure takes a back seat, but even like whatever's behind the back seat, like you don't lead with your age. You're aware of it, but you lead with what the market is doing, and that's what matters most. Okay. So question, Craig, you asked a question. RC, is this $997? That's annually. Yeah, that's $997 a year to get access to everything. And you said the U2 finally stopped. I don't know who was playing the U2. I do not think it was me. Jeff, you have a question. RC, would you use a stop loss to get out, 25% stop loss in individual stocks? Does your service recommend ETFs, individual stocks, or bonds? It recommends all of those above, ETFs, individual stocks, and bonds. What it recommends most is where is the stable uptrend, and what is the most straightforward way to play that. And all positions have stop losses, and all positions should have different sized stop losses on them. So yeah, there's that question for you. Question from Lee, what is your position? What about positioning for Trump? So thank you. The same reason Barack Obama was elected is the same reason why Donald Trump was elected. And before you shoot me hate tweets or emails, let me explain. We are in what I call a contraction cycle, and it started in the year 2000 and is still going on today. And a contraction cycle is when the as reported PE ratio, basically what you pay for $1 of annual income, okay, is going down. So in the year 2000, people were literally paying $45 for $1 of annual lifetime income. 45 represented the PE ratio. Today, it's about 25. So it is moving down slowly. When that as reported PE ratio moves down slowly over time, we are in uncertain times, just like between 1965 and 1982, the Great Cultural Revolution in China, the Berlin Wall, the Vietnam War. This was all during the last uncertainty cycle that we're in, the last contraction cycle we're in. So Donald Trump getting elected, Brexit getting voted yes, Obama getting voted in, they all happened for the exact same reason. People want a change. People are scared. People want something different. So as far as what to do with Trump, follow the price charts. Follow the price charts. Not your belief system, not what you believe should happen, but what is actually happening. And the interesting thing about Trump getting elected, in the hours leading up to his victory speech, it was clear for a couple hours before his victory speech. Okay, his victory speech, I believe, happened at 3 a.m. East Coast time, right, which would have been midnight West Coast time. And I went to bed at 10:30. First of all, I go to bed at 9, but I stayed up because I wanted to see. So about an hour or two before I went to bed, it was clear that he was going to win. The international markets were awake, and they were down 5%. Literally, the S&P futures were down 5% because people realized, oh my God, he's going to win. Okay. As soon as he gave his acceptance speech, like as soon as he started giving his acceptance speech, markets started rebounding and going up and going higher. And by the time the markets opened literally 3 hours later and finished the day in the US, the markets ended higher. Markets love certainty. The markets listened to Trump's acceptance speech. I guess, I don't know what it's called, but I'm calling it the acceptance speech. And the market said, oh, maybe the world won't end. You know, maybe this guy who has said horrible things for the last 12 months, 12 years, 72 years, maybe, you know, he won't pull the temple down on top of him. And so the markets moved higher. What is most importantly is that you follow the markets. And what moved higher were the US stock market. The international stock market fell and stayed down. Emerging markets is falling. It actually reversed still today. Bond prices are falling. Now, they were falling before Trump, but they're falling. And the sectors that are going higher is small cap, mid cap, that's size. As far as the type of sectors, I said sectors, I misspoke. The size, the best size stocks that are moving higher that liked what happened was small and mid cap. Okay. The best type, those are the sectors. Industrials are zooming higher. Financials are zooming higher. And the best location, US stock market. So in your question about positioning for Trump, and thanks, Lee, for bringing that up, you follow the price charts. There's hundreds of millions of people voting. That's why the price charts are so powerful, because they tell you what to do. Question, Roger, what's the difference between your market probability 1, MPX 1, and MPX 2? One is without leverage and one is with leverage. So there's that. Let's see what we have. Why is gold going down with the Trump victory? So this is from Grace. Hey, Grace. There's a reason why gold is going down. First of all, gold was falling before the Trump victory speech. And in fact, the night before his acceptance speech, gold was up 3.5%. And as soon as he spoke, and he didn't speak in any very scary ways, he actually, some people describe it as speaking presidential. I don't know if I'd go that far, but he didn't have the fear-mongering kind of the hate speech that he had been known for the previous 12 months. Gold goes up for one reason, over time. When uncertainty increases, gold goes up. And so right now there's kind of a level of certainty. Now what's interesting is Trump said he wants to print basically trillions of dollars. Printing even more money. That's going to even create more instability. We will go into a recession. And I'm answering your question, Grace. We will go into a recession. So the uncertainty for right now is kind of subsided. And gold is putting in a base, a long-term base. And so that is what's going on right now. Gold was correcting 2 months before the election. And so it's just finishing out its correction right now, and it accelerated to the downside with the election results. But again, the thing that drives gold is uncertainty. And you heard me say a few minutes ago that we're in what I call a contraction cycle, which I could also call an uncertainty cycle, which I could also call government heroic measures cycle. And the best asset during that entire period is gold. Not every day, not every week, not every month, not every quarter, not every year, but over that cycle it is. And the way that I have people in gold is they have a stop loss. So if we do correct back down, we will take measures to step away from gold. And that could happen as things are stabilizing. And I mean with gold stabilizing, I don't necessarily mean the future of this country. It has not stabilized, guys. We are in a contraction cycle. We're in about the 16th year. The average length of those cycles last 17 and a half years. We have a recession in front of us with almost 100% probability that will happen under Trump's watch. And this is a recession that's going to happen with debt at the highest level in the history of this country at any way you measure it, whether it's at government level, state level, municipal level, business level, personal level. We have more debt than we have ever had. Under the Obama administration, we added another $10 trillion from deficit spending to our debt. 10 trillion. That's a form of money printing, guys. So no president in the history of this country has created more debt in absolute terms. We did create debt during the big two wars, World War I and World War II, but it was very specific why we did it. So this debt will come home to roost. There is underlying instability that is there. It will most likely show up in the bond market, and it'll be very invisible for people to see. And one of my biggest worries, which, Grace, this wasn't your question, or Lee, it wasn't your question either, but one of my biggest worries is people who own bonds and are over the age of 50, and they will not see it coming, and it's really going to destroy their wealth. Okay, a couple questions more, and then I'm going to hit the pause button. Hey, RC, I'm in Singapore. This is from Den. Does this apply to me? Absolutely. If you invest money in the market, you have to know the best location around the world. You have to know the best type stock, and you have to know the best size. Absolutely. Since 1998, about a third of my clients have lived overseas, are paid in non-US dollar currency. And this is something that absolutely shifts the way their money grows. But it's different, right? Because of my Australian clients, they never got out of gold like my US clients. They have a different point of view because the Australian dollar has done something very different than the US dollar. So yes, Den, absolutely. It will help anyone that lives overseas. Question from Sylvia. Yes, retirement accounts. Absolutely. You can use these even in very restrictive accounts. 401ks, IRAs, Roth IRAs, 529s, which is not a retirement account, but that's a education account. Even in variable annuities where you have a choice to pick your investments, this absolutely will work too. So it helps there. Two more questions. RC, I don't have time to do trading and timing. Is that a problem? This comes from John. No, I mentioned that before. This is not something that you need to look at daily. And in fact, when there is a shift, I send an alert out to you. And those are not weekly. I mean, these are alerts that come out once or twice a year. Again, it's not more effort that makes your money grow. It's knowing what, kind of the right effort. Last question, RC, how'd you do in 2008 and 2000? We did well. If you remember the one example, I showed you how it performed between, how the market probability performed between 2005 and 2011. It grew people's money 147% during that time period. So even during those catastrophic periods, because we step aside, it really helps you. Guys, thank you so much for being in my world, for listening to this. Take the step. Go to Fearless Wealth today. Sign up. If something goes wrong, sometimes things go wrong when you order. Patty or myself, we follow up with every order and say hi and connect with you to make sure that you get set up properly. And if you do have problems, you can just reach out to Patty at the phone number on the screen, 650-257-0207. I look forward to speaking with you soon. We got the next strategy meeting coming up, and things are definitely afoot with the new president-elect and how things have shifted, especially if you are exposed to international markets or to the bond market. Both of those took it on the chin. And so that could be a very important turning point for those two. Thank you guys so much for the great questions and for being here. You guys take care.